Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah, you're watching Indian Open. Let's go straight to the headlines. The International Monetary Fund downgrades India's 2019 growth forecast to 4.8%, adds that it's a key factor behind trimming the global growth outlook. There are signs of an uptick in the consumer lending business, according to Sanjeev Bajaj of Bajaj Finserv. That is a BloombergQuint exclusive. The government appoints managing directors and CEOs for Bank of Baroda, Bank of India and Canara Bank to help stabilize their operations. And the Income Tax Department claims that many jewelers have failed to justify high-value cash deposits made during demonetization. Well, all of those factors and more have led to some, not upheaval really, but a bit of a pullback in the world markets. I think what the US markets did is one thing, and what they've done all through the last few days is separate. But just bring up the Asian screen in the session today, because that is what is the more relevant piece. Just look at what Asia is doing right now. About 0.74% down for the Nikkei, Hang Seng about 1.66%, and Shanghai down nearly 1%. Now the big news that our headline stated as well is that the IMF has cut India's growth estimate to 4.8% for 2019. Now that alone is a problem as well. But why is it an even bigger eyebrow-raising piece is that if you look at what's happening across the region and related regions, things are slightly different than what's happening in India. And we've seen the data suggesting for a while that Indian growth numbers, export numbers, etc. is all looking poor. But look at this. For the rest of the EM and the Asian Pac, analysts, for example, have raised their EPS estimates for the emerging market companies this year. This is part one. So India is dichotomous in that nature. And part two, if you look at back home in Asia, exports for most of the large Asian economies are actually showing signs of bottoming out or actually even a pickup. Now that is also not happening in India. So not that India is going down because the other markets are also going down, but the other markets are showing some green shoots. We don't have that kind of green shoots visible as yet. Some high frequency indicators, some management comments, the way of Sanjeev Bajaj yesterday point towards that, but not as a general rule. Now, I don't know if all of this leads to the markets correcting or no, or whether it was the banks which led the markets correcting yesterday, but the SGX Nifty after the cool off yesterday, or after the 1% pullback yesterday, shows a further downtick or indicates a further downtick in the session today. And yesterday wasn't a particularly pretty day for trade really, because one, we saw significant cash market selling. DII sold about 1,400 crores, and we had HNA activity to aplomb yesterday, and there was a long unwinding that was essentially cash market selling and long unwinding punctuated the day of trade yesterday. And if the bank Nifty weakness continues, which in all likelihood it could, if Kotak's commentary is anything to go by, then you might well have that bearing in on the markets. If there's weakness in the bank Nifty, and if Reliance is not active, which it may not be, then you likely have the markets under a spot of bother. So there's a start in the red for sure. I don't quite know if it's easy to predict that there could be some bit of bottom buying. The last few days the market has seen every dip being bought into. I don't know if this is the time just as yet. Keep that at the back of your mind. The clutch of numbers today from the index, Z Entertainment comes out, but non-index, the clutch of very important large numbers that you need to monitor in the session. There is HDFC AMC, an expensive name in its own right. ICICI Prudential, which is not expensive and trying to pick up. Havells, again, a premium name, and Havells competitor Polycab comes out with numbers as well. So 3 or 4 key names that you need to monitor in the session today. The stocks to watch: after a big pull down yesterday, Kotak Bank would be an important one because the con call takeovers were interesting. I'll let Shefali do the bulk of the talking, but I just want to highlight 2 points that I thought were important. They've said in the con call that the credit growth has been revised to 16 to 17% versus 18 to 20% estimated at the start of the year, and loan growth guidance has been lowered down to less than mid-teens. We haven't seen this happen to Kotak for a while. I don't know if there's a further pullback in store in the session today. Do watch out for that one. ICICI Securities, I thought the numbers were good. The stock has rallied a bit. It's still not very expensive. And even though the revenue growth numbers were just 4.1%, the net profit number was very interesting. They've seen broken market share gain, and they've seen the cost or OPEX cost optimization, which is something that they'd guided to, that they will do. The market wanted to see the proof of that. Now the markets have seen the proof of that. I guess the market should be happy with these numbers. Let's wait and watch. You'll hear the management, of course, at about 9:50 on BloombergQuint. KEI Industries, the stock had a big crack in trade yesterday. Now the numbers have come out. They're pretty much in line. I mean, net profit up 20%, revenue is up 20%, net profit up 49%. So all of that is fine. I think the management expects to achieve about 18 to 19% growth in FY20. In 9 months, they've already done 22%. So I don't know if they're guiding towards a soft exit in the quarter 4. Let's wait and watch if that indeed happens and how the market treats these numbers today. HG Infra, it's a small company, but they've received an appointment date from NHAI for a HAM project in Haryana. Maybe that keeps the stock excited. And lastly, MCX, it's a stock that is very active. UBS has gone ahead and raised the target price to 1650 from 1200, of course, maintaining a buy. Let's wait and watch if MCX has a good day in trade today. But banks, in all likelihood, will be the key thing. However, let's tell you what's lined up on First Word today. The top stories that we believe we should bring to you, and I don't think it gets bigger than this. IMF Chief Economist Gita Gopinath explains why it slashed India's growth forecast so drastically. Shefali then takes us through Kotak Bank's conference call takeaways and also does a small comparison with what HDFC Bank has done in the quarter gone by. Somit then looks at the possibility of Vodafone and Idea shutting shop, and Darshan then tells us why Divi is in the best of health of late. The International Monetary Fund cut its global growth forecast for 2019 for a 6th consecutive time, and the slowdown in India is a major factor for the downgrade, according to the chief economist Gita Gopinath. In a conversation with Menka on the sidelines of the World Economic Forum in Davos, Gopinath emphasizes that the government needs to support growth without losing sight of the fiscal consolidation targets in the medium term. Listen into that conversation.
For the global economy, we have growth at 2.9% for 2019 and then 3.3% in 2020. Now, this is a 0.1% downgrade relative to the past. So this is quite slight. We've had a significant downward revision for India, over 100 basis points for each of these years. And it's probably the most important factor for the overall global downgrade of 0.1%.
Okay. Before I come to India, you've said in the report, few signs of turning points are yet visible in global macro data. What are you watching closely to get a better sense of if there could likely be a growth pickup in the second half of this year or maybe even next year?
So 2019 was a year when we described the world as being in a synchronized slowdown because pretty much all countries in the world were growing slower than they did in 2018. Now, towards the end of 2019 and now, we're seeing some high-frequency indicators, especially with manufacturing and global trade, that looks like there's some signs of stabilization. But we're not seeing a recovery yet in investment, and that would be something we would pay close attention to see what's happening with the strength of the global economy.
You think the trade headwinds rather, seem to have stalled, if not passed, given that we're finally seeing some sort of phase 1 agreement between US and China, or is it too early to tell?
So the US-China phase 1 deal has certainly reduced uncertainty with regard to trade policy, and that has helped. So we've upgraded China, for instance, by 0.2% for 2020 because of that. I mean, but that said, the risks are not off the table. Trade uncertainty remains. Now, the one sector that was part of the reason why trade was also weak was the auto sector that was shrinking quite severely in 2019. And we're seeing some, again, tentative signs of stabilization there.
Broadly speaking for the world, as well as, of course, applicable to India, you've said emphasizing a balance between monetary and fiscal policy, that national level policies should provide timely demand support. Now, we're on the annual of the budget in India, which, as you know, is a big thing, and we're hoping that that will provide some sort of fiscal expansionary support to the economy. What do you think is the best course of action the government could take?
Well, let me just be clear, for instance, on our fiscal advice, it's important for countries to have the fiscal space if you're not a country with very large levels of debt or already very large fiscal deficits. Now, in the case of India, it is important that the fiscal targets are met, at least from a medium-term perspective. And it's also important that if spending is done, it's done on public investment as opposed to consumption spending. Now, there's also other stimulus in the system in India, which is the monetary policy rate cuts that happened in 2019 and the corporate tax cut that happened in the fiscal side. So there is a stimulus. I would say that in terms of the major issue to deal with is the weakness in credit growth. How do you get credit growth back up? But at the same time, making sure that there is not going to be a second round of non-performing assets in the future. I think that's the the balance that the government has to hit.
You dwelled in detail on that in the last interview you did with BloombergQuint, so I won't, spend more time on that. But when you speak of investment in infrastructure, let's say, as opposed to consumption, or you speak of longer-term measures, or you speak of the fiscal space, the point is we're at 5%, and we desperately need something to do something to get growth back up. Are you suggesting that if the government were to do something on the consumption side, that would not be viewed well by the world?
Again, I don't want to make a blanket statement on this particular issue, but what is important is to address the underlying source of the problems. The underlying source of the problem is stress in the financial system. And some of that has to do with non-performing assets that have been around for a while. So there has to be faster resolution, and I talked about how you might need greater infrastructure there in terms of being able to get timely resolution outcomes. So those kinds of issues have to be dealt with. On the fiscal side, it is also important to make sure that you have sufficient revenue mobilization, including from the goods and services tax. So those aspects have to be dealt with. It's not always the case that if you were to increase spending, you're going to make the deficit worse, because you can shift spending from one area to another, and that can have an impact on growth. So there are many ways to doing this, but I just want to flag that it's important for there to be a medium-term fiscal consolidation target for India.
No, fair enough. I think we've had one for a while, and we've not necessarily been able to stick to one. The only reason I keep emphasizing this point is because it does seem as if almost everyone is in favor of fiscal discipline, but that will not improve a 5% growth scenario in any way, unless the base effect kicks in next year and the year after that. So I'm just curious, what is the way out of this sort of trap we've gotten ourselves into?
So we have a projection, for instance, for growth in India to recover from 4.8% to 5.8%.
Yes,
and that recovery is based on stimulus that's in the system without any further stimulus. So we do expect that with the monetary policy stimulus that's in there, with the corporate tax cuts, with the rural income transfer program that's been done, that should raise growth in a year from now.
And it's important for the government to keep their eye on just that recovery and fiscal discipline versus spending a bit out of their pocket this time.
No, the question is if it's a bit or a little bit or a tiny bit. Again, I use the word about this being important from a medium-term perspective. I think whatever deficit or whatever policies undertaken, it's important for it to be comprehensive in the sense of signaling that you do have a medium-term goal and you plan to stay to it, and in a way that's credible, right? Not in a way that gives people reason to be anxious.
And there are countless pieces in favor of some near-term spend on the consumption side, which might spur the economy, versus why it does not need to be done and let the recovery take its own sweet time. Debatable. Gita Gopinath believes near-term spends on consumption might not yield the results. She was non-committal, I think, in all her answers, but she did mention that she believed that there needs to be a medium-term fiscal deficit numbers in mind, and there will be a natural course of recovery that might come in this conversation with me. And of course, you can hear that conversation, read more about that on our website, BloombergQuint.com. So do try and see. This is arguably one of the biggest stories of the day, not just because it impacts India's growth numbers, but because of India's growth forecast. It also has impacted the world growth numbers. What could contribute to that? Well, consumption, lending, lots of things. Kotak Mahindra Bank missed estimates in the third quarter, and what perhaps disappointed the market more than the bottom line numbers was its relatively soft loan growth. The private sector lender is also conscious of the slowdown and attributed it to the overall environment. Shefali had logged on to the earnings conference call, now joins us now for more on that. Shefali, what were the key takeaways?
Well, some of the key takeaways were that the deposit growth that they are seeing, which was again a bit on the softer side, 12%, that should hold on, if not improve or become lesser. It should hold on. And more importantly, or rather in addition to that, the lending growth. So the reason for the softer lending growth this time around amongst private banks that have reported so far. Their lending growth was on the lower side, just about 10%. So what was the reason for that? They said that there are lack of lending opportunities with suitable risk profile, and the management was management said it very strongly during the con call that they are not bothered about the numbers, they are not chasing numbers, but they would do what they feel is correct at this point in time. So that is something that they said very strongly, so that they are not really bothered about a certain percentage growth rate. And also the corporate book is not panning out too well for them, so that the growth in the corporate book was below the usual trends. And something interesting that they said is that even the existing limits that some of the corporates have, the large corporates, those working capital limits are not being utilized to the fullest. So remember, last earnings season, State Bank of India chairman said that as the working capital utilization picks up, the lending will pick up. At least from Kotak, they are saying something, it's that trend is not visible, or at least that is something that they are letting us know that is not happening. And also the vehicle finance book that has slowed down, just like for everybody else. And something that another interesting point is that because of the rate cuts, the corporate tax cut that has happened, that has given them room to grow in certain segments such as home loans because of the lower cost of funds and better risk adjusted returns that they are seeing now in some of these categories. So that is one thing. Apart from that, they think that in agri book they haven't seen much of NPAs because their book is because their book is collateralized by gold. So they're not seeing too much of pain. And some of the areas where they are seeing asset quality issues, large corporate accounts that reflected in this quarter, CV segment and unsecured book as well. So in credit cards and personal loans, they did see some delinquencies. So they said that it's in line with what's happening with the broader trends, something that the Bureau has also put out, the CIBIL data that came out. It's in line with that. So it's not a panic situation when it comes to the unsecured book, but yes, their delinquencies have gone up in the segment and they are more alert than before. That's what the management said over the con call yesterday.
Did analysts sound perturbed about the fact that the credit growth guidance has been revised lower, or the fact that the loan growth numbers are also now in sub mid-teens? Did anybody sound perturbed? Have the notes sounded concerned about that?
No, not really. In fact, one of the brokerage notes very aptly titled it that it's structurally strong but cyclically weak.
Cyclically weak.
So,
okay.
so probably that's the way they're looking at it. Nobody has cut down their target prices. Nobody has changed the ratings. So probably it's just the overall macro environment. So so people are taking it positively only, or seeing this as a prudent measure. But one of the notes said actually that probably Kotak management is becoming a little extra cautious, probably, which is not warranted, but that is one of the opinions. But nobody has really changed
Nobody
the
changed the
target
prices. Okay.
Yeah.
Now let's try and do this. Structurally strong, cyclically weak. How does it compare with yet another peer which is usually structurally strong and at times even cyclically strong, HDFC Bank? Now that we have the two bellwethers come out with numbers, what are the similarities? What are the differences?
Well, in both there were a couple of things, few things good and few things not so good. So a bit here and there. For instance, for Kotak, the net interest income growth was 18%. For HDFC Bank, that was the lowest in couple of quarters, 12.7%. And what contributed or what supported that the net interest income figure for Kotak was the increase in the margins. Their margins actually expanded. They already have the highest margins. So margins even went up further by 8 basis points to 4.7%. And in the case of HDFC Bank, the margins were actually just about flat. And the reason that HDFC Bank attributed to lower NII growth is the low yielding assets. Whereas for Kotak, their strategy has been to focus on the high yielding assets. So they are not bothered about the number, chasing the number, but focusing on the assets which are giving them higher yields, or which has a good risk reward ratio. So that is the top line. Other income, Kotak saw a growth of 132% on a YY basis. HDFC Bank 36%. So on their respective basis, both of them are doing well on the other income, partly because of the recoveries happening and treasury income also, which is coming in this quarter for most banks. PPOP growth, both are similar, 23%, 20%. Profit growth, Kotak was 24%, HDFC Bank 33%, and loan growth, we've already spoken, Kotak was 10%, HDFC Bank was 20%. So here HDFC Bank had a better quarter this time around, and deposits growth again, in terms of the pure business metrics, HDFC Bank did better when it comes to loan growth and deposits growth. Yeah, significantly better, almost double of what Kotak has done. And in terms of asset quality performance, HDFC Bank had agri slippages, which keeps on coming for them because of their portfolio, but otherwise the QOQ increase, the gross NPAs in absolute terms was more or less similar for both the banks.
Okay, so in purely business terms, loan growth as well as deposit growth, I think HDFC Bank has done far better, and this is just the share of deposit, Shefali, which might make it an attractive proposition, simply because low-cost deposits might actually be the key for a lot of banks. But yeah, very interesting analysis. Thanks so much for putting that into perspective, Shefali. So Kotak Bank on-call takeaways now you know, and the comparison with HDFC Bank and what they have done. Both have their pluses and minuses. Kotak Bank would be an interesting one to monitor in the session today after the con-call details that have come out yesterday. Vodafone Idea is liable to pay the government nearly 35,000 crores in adjusted gross revenue dues after the Supreme Court rejected its review petition. This puts the company's ability to continue operations at risk. Will Vodafone Idea be forced to shut shop, though, is the question. Or is there a way out for the telecom operator? Sumit Sarkar is standing by with an analysis. Sumit, very, very difficult question. So let's caveat all our findings, but could this be the end of the road? Or is there a way out?
There is some way out, but we'll see why this could be an end of the road for Vodafone Idea firstly. Now, due to the dismissal of the review petition filed by the telecom companies related to the AGR dues, Vodafone Idea could be on the verge of a shutdown. Now, that is because it is unable to pay this dues. Now, Vodafone Idea needs to pay nearly 36,000 crore rupees in the AGR dues. Now, this is 3 times its market capitalization. If you see, the market capitalization of Vodafone Idea is close to 13,000 crore rupees, while the dues that they have to pay is nearly 36,000 crore rupees. Now, the promoters are reluctant to put in more money in the company, while 75% fall in the share price of the company since the last round of fundraising that was done in March 2019 rules out the possibility of further raising funds from the market again. So as you can see, the 75% fall in the share price of the company since March 2019, and the promoters have also ruled out the possibility of raising funds. Now, along with this, the company not only has the highest debt in the telecom industry, but its leverage ratio is also the highest. As you can see here, Vodafone Idea's debt is close to 1,02,000 crore rupees, while its total debt to EBITDA, as the leverage ratio, stands the highest at 7.6 times. Now, at the end of second quarter of financial year 2020, the company had a cash balance of nearly 15,400 crore rupees on its book. Now, this was lower compared to the previous quarter, and that was because the company has been continuously burning cash because its revenues are not enough to pay for its costs. And as you can see, since the time of completion of the merger, the company's free cash flow has been negative. In the second quarter of financial year 2019, it was negative 5,400, while in the second quarter of financial year 2020, it was negative 3,800 crore rupees. Now, according to Motilal Oswal, the cash that the company has, that is 15,400 crore rupees, will be sufficient to continue operations for Vodafone Idea for the next 2 to 3 quarters only. Also, the company did a recent tariff hike to improve its financials, but according to various brokerages, even this tariff hike would not be sufficient for Vodafone Idea. Now, CLSA posted a report post the tariff hike in which they said that the company will still struggle to fund its spectrum and capital expenditure payments even post the tariff hikes, while Axis Capital and New Street Research said that the company needs 70 to 75% higher average revenue per user to meet its quarterly expenses.
So if the current tariff hikes are not enough, Sumit, what could save Vodafone Idea? I heard you say that there could be a way out.
Well, only 2 possible scenarios that could save Vodafone Idea. Firstly, it is government interventions, and second is a steep tariff hike that could save Vodafone Idea from a verge of a shutdown. Now, why government will look to intervene in this? Because if they do not, most of their revenues will be hit. Along with that, there would be a problem in the banking system and a reputation hit for India as an investment destination. Now, more than 80% of Vodafone Idea's debt, as you can see in this chart, nearly 81.6% of Vodafone Idea's debt is owed to the government. Now, the total debt, including the AGR due, stands at close to 1,53,000 crore rupees, of which nearly 1,25,000 crore rupees is owed to the government of India. So this is the first reason and the main important reason why the government of India would look to intervene. Now, along with this, if a possible waive off is given by the government when it comes to the interest and the penalty charges, that would also help Vodafone Idea, because of the total 36,000 crore rupees of dues, nearly 75% is interest and penalty amount. Now, along with this, a combination of a staggered payment and a steep tariff hike could also help Vodafone Idea in this. But in this tariff hike has to be steep enough to take the average revenue per user to nearly 200 rupees per user from current ARPU, that is the second quarter ARPU of nearly 107 rupees. Now, this 200 rupees ARPU is too optimistic, but could be possible only through fixing a floor price on tariffs in India. But it's too optimistic to get an ARPU of 200 rupees at the current times. Now, what the other brokerages are saying, like most of them are saying that government intervention is a must. IFL is saying that government is likely to spread out the payments over a longer period, that is 10 to 20 years, and along with this, a tariff hike would be a feasible combination for Vodafone Idea. Edelweiss is saying that the government will have to step in to grant a waiver or defer the payment of this AGR dues for if it wants to sustain a three-player market in the telecom industry. Jefferies is expecting a moratorium on the AGR dues for the first 2 years and then a staggered payment, which would also aid the cash flows of the company and make Vodafone Idea survive this issue, while ICICI Securities is saying that the payment of dues for Vodafone Idea is a challenge, and this can be resolved only with the government intervention coming in. So all the brokerages are expecting some government intervention to come in. So we'll have to wait and watch how that pans out for Vodafone Idea.
Well, that's not a good space to be in, that in order to survive, the government intervention becomes the key factor, but that it is as it is. So, thanks so much for putting this into perspective. We caveated here again that a lot of these assumptions could be different for different people and may turn out in a different fashion, but this is done to the best of our estimates for Vodafone Idea. The last piece on First Word today is on a particular pharma business. Now, Indian pharma players have been grappling with regulatory changes for some time now, right? And Divi is no different. But the Hyderabad-based generic drug maker had run into the FDA crosshairs as well in 2016, but has since managed to resolve some of these issues and is now giving Dr Reddys a run for its money as far as market capitalization is concerned. Darshan is here for more on that. Darshan, it's very interesting to see that at a point of time in the last 1 month, Divi was the second largest company by market cap. How has it managed to do this?
Yeah, so basically it managed to first of all resolve its FDA issues in record time of 9 months. If you see what's happened, basically the generic companies, the market cap has come down significantly. Obviously this is number 2 to number 6. Sun Pharma obviously is over the 1 lakh crore mark, so that is somewhere. But now if you're looking at it, it's a 2-horse race for the second market cap. Dr Reddys and Divi's both at a 50,000 crore market cap. So there is definitely trending that's happening, and there is traction that's happening between both these companies. Now we will talk about Divi's, what exactly has happened. If you take a look at what happened, the stock price is trading at near record highs. The issue started in 2008, managed to rally, it was doing extremely well. The issue started in 2016 where they got a Form 483 with 5 observations where the community did believe there were data integrity issues, and then there was this warning letter and the stock just managed to collapse almost 50% in a matter of 5 months. But they managed to get things right. They expect the US FDA came and they resolved the entire issue, and post that has been a rally from levels of 500 is almost close to 2000 now. So there is definitely positive trend that coming in for Divi's lab now. Now there are a couple of things what it has done. First of all, just to give a sense of what exactly happened, in December 2016 the US FDA issued a Form 483 with 5 observations on the Vizag Unit 2, which was almost 70% of their business. And in March 2017 there was an import alert because there were issues of data integrity which was found by the US FDA. Now in September 2017 the US FDA re-inspects the unit and issues a Form 483 with 6 observations again, and surprisingly, when everyone thought that it will be gone, it will be trouble for Divi's for a long time, in November 2017 the import alert was lifted. Just to clarify, Divi's is an API manufacturer, not a formulation manufacturer. That is why the US FDA, probably the clearance came in much sooner than a normal formulation plant. Now in terms of how it's being doing, On the financial side, take a look at the revenue. So it did manage to dip significantly. Ever since the import alert came out, it's been rather flattish in trade. But over the last few quarters, it's consistently, doing, revenues almost about the 1200 crore mark. So they've managed to improve revenue significantly. Even if you're looking at the profit number, if you're looking at the margin number, obviously the profit which fell in significantly post all the US FD issue, they've been managing to commit to, do well. And over the last few quarters, they have managed to inch up their profits also. Margins, they were one of the companies that did margins to the tune of almost 40%. Post the import alert, they went below the 20%, 30% mark. And again, margins now are coming back to levels of almost 35 to 40%. Obviously, there were some issues with imports from China that impacted the margins, but nevertheless, the trend certainly seems to be on the positive side for Divi's. Now, what's fueling the Divi's run and what exactly is working? Obviously, in terms of the balance sheet, very, very strong balance sheet, net cash positive, and that is why they are able to actually go ahead with expansions. There are a lot of restrictions on China because of the environmental pollution issues that are there, and plants are getting shut down there. So India becomes a preferred choice for API manufacturers, and Divi's is one of the largest one of them. Now they have a 1700 crore capex, which gives that there is order visibility. Now Divi's, if you take a look at historically, the asset turn is very, very high for Divi's, which means that they will go ahead with a capex and only if they see revenues coming in, and there is definitely order visibility that is there. The backward integration that they will do will definitely help them, because in the second quarter you saw issues with China and their imports, which actually impacted their margins. Once the backward integration is complete, it will be much better for Divi's. And finally, execution record is extremely strong. There is a moat among businesses. They have limited number of APIs, but they are so strong in it, and they have excellent market shares. So that is something that is aiding them. The other aspects is it remains focused as an API player. It is not diverging and going into formulations which some of the other API companies did and then faced headwinds. Low cost business models, like some of the other API companies which did acquisitions in Europe and US, where the cost went up. Divi's has been consistent. It will manufacture in India only, and that too at a low cost structure. And the return ratios are in excess of 15%. So that is giving an indication that the return ratios are very, very strong. So these are some of the factors that have helped Divi's. Some of the risk, obviously, valuations trading at 30 times compared to some of the even the larger formulation peers like Sun Pharma, which are getting at 20 times. So valuations is expensive. They want to do a backward integration and remove all the bottlenecks. So in case there is any delay, that means the financials definitely will get impacted. So these are some of the risks that Divi's has. Most of the analysts have a buy recommendation on Divi's, but because of the run-up, the potential return is a negative 5% now. But majority of the street does believe that Divi's is a buy at this point.
Well, interesting. And the run-up shows it in the way this stock has done. 27% might not seem too much, but for a pharma company, I think it's pretty interesting returns. Thanks so much for that, Darshan. That's the piece on Divi's, and that's all that we have on First Word today. But as the earnings season picks up steam, we have some conversations lined up on Indian Open. We get your slice of maincast conversation with Sanjeev Bajaj, the MD and CEO of Bajaj Finserv at 9:30 a.m. That's the big one. Then turn focus to corporate earnings. Shyam Srinivasan, the MD and CEO of Federal Bank, and Vijay Chandok, who heads ICICI Securities. But after this break, a full tilt towards the race to it.